I think the reason why we connected to begin with here was that, I saw a post on LinkedIn from you and then started following you. And then I was just kind of blown away at a lot of the stuff that you post. Because I love to see people that post stuff for free, right? Like really good information. You can tell they know their stuff. And they're just posting because they want to have more educated, individuals, whether it's clients or whether it's, retirement advisors, whatever it is. And I really loved it. And I learned a lot from you. So thanks for being on here. Let me ask you this. Why don't you tell everybody a little bit about you and kind of your background and all of that? And we'll get into some of our questions.
Yeah, sounds great, Tracy. Thanks for having me. More than anything, I always love that people are willing to embrace this conversation around taxes because that is what I spend all of my time doing. So, Steven Jarvis, I'm a CPA. I am based in Spokane, Washington, but I run a virtual firm and a virtual team. I actually work with advisors all over the country. So I've been doing this CPA thing for quite a few years now, and for the first several years, I did stereotypical CPA things. Whatever if you close your eyes and think this is what a CPA does, you're probably pretty close. I worked in big offices, sat in cubicles, worked too many hours, all those kinds of things, and had very much leaned into this idea that you get at big accounting firms, big law firms, that the only way you're going to be successful is if you become a partner at a big firm. And I was right on the doorstep of that. I literally went to the meeting with the chairman of the board of directors of a firm of 7,000 people, where I was supposed to become a partner, and I said, actually, I'm quitting. And it was one of the scariest things I've ever done. But you rewind the clock a month before that meeting, and some financial advisors had come to me and basically said, "Hey, we can't find CPAs who will play nice with us. We want you to help us create a solution where we can help advisors do more with tax planning and tax preparation." And when they told me that, I'll be completely honest, my first response was, guys, that sounds like a really simple idea. You're basically just saying professionals should be nice to each other. And they said, okay, great. If you can find where it already exists, we'll leave you alone and we'll move on with our lives. And so I started looking into it. And I was like, oh, no, this is a huge issue. Education around taxes is a huge issue. Resources around taxes are a huge issue. And I grew up around financial planning. My dad got into insurance sales and then became a CFP when I was 9 or so.
Okay.
But I had never been an entrepreneur. And so really, as we started having this conversation, what surprised me was how excited I got about the idea of starting my own company and being an entrepreneur. And so here I am 2.5 years later. We work with hundreds of advisors under our membership programs. I've spoken to thousands of advisors, if not more at this point. I speak all over the country. I've got 2 podcasts. I've written a book. I do a lot on LinkedIn. And most of what I do really is, I mean, you hit on it, Tracy, but a lot of what I do is really centered around this idea of I want to give almost everything away for free. And then the people who are really excited are going to come and work with me anyways.
Wow. That's 2.5 years. Get out of here.
Yeah,
Crazy.
2.5 years.
What a ride, huh?
Yeah, it has been. If I think back 3 years ago, if we were to go to and talk to Steven 3 years ago, and you said, "Hey, what do you think? What do you think you're gonna be doing around podcasts in 3 years?" And I'd probably say, "Well, I'll like once a quarter, I'll pick a Joe Rogan podcast and listen to it. Like that. That would be my extent of the involvement in podcasts." But yeah,
Wow.
so it's been a whirlwind. It's been exciting. It's been challenging in all sorts of ways, but it's been really good. We actually just hosted our first conference where we got 100 people from all over the country, flew to Vegas and spent a day and a half with it, almost 2 full days learning about taxes.
Love it. I love that. That's actually a big way that I got became just more affluent in a lot more things other than just the insurance world was conferences, going to conferences, meeting people. It's just an amazing thing to do. So I'm glad you guys are putting one on, and I'll have to keep an eye out for the next one you guys do. Go ahead.
I'll say we've already got the next one planned. It's next
Oh,
year,
you do?
September 25th through 27th. It's going to be in Phoenix. So yeah, mark your calendars. It's
Awesome.
going to be good.
Awesome. Okay, sweet. I love Arizona. I went over there one time meeting with some family, and it's a different kind of beauty out there. It's very different, right?
Yeah.
So cool. I got to ask you, all these medals in the background. Tell me about them. Come on, people got to ask you about those.
They ask me all the time, and so of course I have my cheesy jokes about them. I tell people that the trophy shop by my house has a bulk discount, those kinds of things. But no, so a lot of them are Spartan races. There's some 70.3 Ironmans in there, half marathons, those kinds of things. it's I mean, it really, they hang up there just as much for me as for other people. I got into racing, I'm not an elite athlete by any means, but I got into it quite a few years ago. I had gotten in a bad car accident, and my physical therapist told me that I needed to stay active so I wouldn't have issues. And then, just to be totally honest, this probably isn't the route you thought this conversation was going to go, but I also realized several years ago that my physical health is very closely tied to my mental health. And that's true for most of us, and that's a conversation a lot of people don't really want to have.
Right.
But I've literally had clients get on and say, hey, our last CPA had a mental breakdown. Like, I'm sorry to be so blunt, but how do we know that's not going to happen to you? And I can say, actually, well, I mean, I can't guarantee anything,
Right.
but I'm very committed to making that not my reality. And actually, so as we're recording this, I'm getting ready to do the world's toughest mutter this weekend, which is a 24-hour obstacle course race just outside of Dallas, where
Wow.
they have a 5-mile loop that I'll try to do as many times as I can in 24 hours.
Wow. That is amazing. So do you have to do some extensive training, or is it just you stay fairly fit most of the time? How's it work for you?
It's a combination of the two. So this is the first time I've ever done a 24-hour race.
Okay.
So about a little over a year ago now, I joined a local CrossFit gym, which I had done off and on for years as I traveled. I've always been fairly active, but so now I maintain a pretty high level base fitness, and then whatever my next set of races is, I will train a little bit more specifically for.
Wow, that is awesome. It's coming from a guy who was an athlete. I say was because I was. And I was in the military, and in the military, you when you're doing any type of PT, we have our tests we have to do, and I was a 300 guy. So 300 is a max score, push up, sit ups, 2 mile. So I was in really good shape. This type of stuff, I love to hear it because you have kids, blah, blah, lots of excuses, right? Anybody can put that excuse box and
So many
put it out
excuses.
there. And I talk with people, and it's like, man, I really got to get back into a fitness routine. And I used to tell people, because I used to do a lot of just kind of like on the side training for just like friends that had absolutely not, they had zero clue when it came to fitness, what to start with. It was like anything is better than nothing a lot of times, just movement, movement, movement. I would tell people, just go stretch for like 30 minutes. Like 30 minutes, I'm like, try an hour, to go stretch for an hour. Could you even think about stretching for an hour and then watch your body change? So that's awesome, man. I love that. I love that message. Make sure to post and let me see how all that goes. Hope you got great pictures and stuff, because I love that kind of stuff.
Yeah, absolutely.
Yeah, yeah, different direction. That's okay though. Let's go back here to tax services in retirement. Such a need. And from a guy who, for anybody who's watching this doesn't know a lot about me, my focus is specifically annuities. That's it. That's what I do. And it's interesting because it's such a niche thing, but guess what you have to know? You have to know a little bit about everything to do them appropriately, right?
Yeah.
So tax is a big part of the areas that we don't know a lot about. Myself, even other advisors. We have CPAs that work, or I'm not CPAs. We have CFPs that work with us. We have CFAs that work with us. We have Series 65 broker dealers. And guess what? They don't. A lot of them don't know a lot about taxes. So here's a question for you: taxes in retirement. How do tax considerations in retirement differ from tax considerations out into the workforce? What are some big key factors that advisors should know and consumers should know?
Yeah, the very first thing that comes to mind that a lot of people get wrong as they transition into retirement is just understanding how their taxes get paid. Because you mentioned how they differ from being in the workforce. And so if we take for a second just people who are W-2 employees, because that's a lot of people. They spend their
Right.
lives as W-2 employees, do a great job saving for retirement. They suddenly get to retirement, and now their financial situation is completely different. Even if they've done a great job saving and they have the same income level, it's coming to them in a different way. They have a lot more control now. And all of a sudden, they don't have an employer who is making sure their taxes get withheld. And so,
Right.
especially that first year of retirement, I mean, you want to add a lot of value to a client. Make sure you hold their hand the first year of retirement to make sure their taxes actually get paid. Because that's a really, really crappy way to end your first year of retirement, of getting to tax season and realizing you got to write the IRS a $20,000 to $30,000 check because no one withheld
Right.
taxes during the year.
Right.
That can be really uncomfortable. But from a higher level, again, if we stick with W-2 employees for a minute, one of the things that happens in retirement is that suddenly we do have a lot more choices, not just how our taxes are withheld, but especially for a lot of people anymore, the way the tax code is set up, our income is going to build as we get into retirement. That when we first start into retirement, we might have a severance of some kind. Maybe we're still doing some consulting or some kind of side hustle. Who knows what that might look like? We might have a pension, although that's becoming more and more rare. But eventually, we're going to turn on Social Security. We're going to most likely turn on required minimum distributions, and so we're going to have years where we can anticipate what our income is going to be and when it's going to increase or decrease. And so now we can start making decisions about intentionally recognizing income, because instead of when we were working and we were just hoping that we would keep getting paid more and more and more, we can say, okay, from a tax perspective, is there something we can do to push income out of certain years or pull extra income into what might be relatively lower years otherwise? And we can start doing these things to start sanding the rough edges off of our retirement tax bill. I'd like to tell people that I'm all for paying every dollar you owe, but there are no patriotic awards for tipping the IRS.
Yeah, right. Right. That's good. It's funny from a tax perspective. I was just talking with my parents, and my parents are like, oh, we get X amount of taxes back at the end of the year. We love it. And I think about that. I'm like, well, you just pretty much gave the IRS a loan for free for however many months you paid that in. But I would say, I think I would probably, from a normal standpoint, I would probably say that that's better for most people. For me, I would rather pay at the end of the year personally, because I can do different things with my business. But I think that is a great segue to everybody's a little bit different, right? Everybody's taxes are very different, tax situations. So here's a very pointed question for you, a big one that a lot of advisors talk about, which is Roth conversions, right?
Yeah.
So that's a big one. So in general, I want to get your thoughts on Roth conversions in general for retirees, and then also how the Secure Act 2.0 is obviously, has changed things. And then as of 2026, tax brackets are changing again. If you can connect those two things or separate them, whatever you'd like, how do you feel about those two things?
Yeah, so from a high level, I think everyone, absolutely everyone, should be considering Roth. That does not mean that the answer is going to be Roth for everyone, but everyone should be considering it. The reason I say that is because it's a tax-free bucket. We get money into Roth, and now we've cut the IRS out of the picture. And
Right.
there's going to be people listening who will say, "Wait, Stephen, even you say the tax code's written in pencil. Congress could change it next week." That is
Right.
totally true. My crystal ball is just as broken as yours. But if we want to get a little philosophical for a second, the reason Roth was invented by Congress is because it accelerates income to the government. They're asking for your taxes now so that they can go and spend your taxes now. And every year, there's a bigger and bigger voting block that has Roth dollars. If you want to ensure that you will never get reelected again, why don't you go ahead and make that entire voting block mad? So I'm sure taxes will change 100 times between now and when I retire. I'm just personally not afraid that they're going to take away Roth somehow. They might change how you get money in there. And so that's another thing that gives me comfort is I'm recommending to my clients the same things I do personally. So I personally look at how do I get dollars into Roth. And since I'm younger than some of my clients who are getting into retirement, the way we're going about it might look differently. But every year we're looking at does it make sense for us this year to get more into Roth? And for people who are still working, when you're in your peak earning years, if you think there's a reasonable expectation that your income will go down significantly in retirement, maybe there are some years where we're better off not putting dollars in Roth. But I work with advisors who are working with clients who are in the top tax bracket now and will always be. And so I get a lot of people who say, oh, I won't do Roth conversions above the 22% bracket. Okay, that might make sense for your clients. I know advisors who are doing Roth conversions all the way up through basically 40% when you tag on all the extra taxes, and their clients are thrilled about it
Right.
because they're in the highest bracket now and they will be forever. You mentioned 2026. That's just one of the things we talk about, because anytime I'm having a conversation about Roth, the way I start this is not tied around specific dollars. It's really just with a concept. And it's Mr. and Mrs. Client. All of my fictitious clients are Bob and Sue. So I'll probably refer to Bob and Sue during this conversation. But it's, hey, Bob and Sue, are you concerned at all that taxes might go up in the future? And not surprisingly, everyone says, well, of course, look at the national debt, look at how low whatever their reasoning is, everyone is worried that taxes will go up. So, all right, would it be okay if we work together to try to get some of your savings into a tax-free bucket so we cut the IRS out of the picture? And they said, well, of course that would make sense. Yes, let's please do that. And then we take a look at, okay, what does that actually mean for this client as we kind of pencil in what do the next 5, 10, 20 years look like. Do we get really aggressive with Roth now? Do we wait for those kind of that sweet spot between ending employment but not turning on Social Security and RMDs? And then we've got to look at amounts and things like that. But we already know tax rates will go up in 2026. And the joke I like to make there is that if Congress does nothing, which is what they're best at, then tax rates by law will already go up in 2026. And so especially for people right now who have just retired, have a few years until Social Security, they're kind of in this magic time where tax rates haven't quite gone up yet. Let's get some things converted.
Yeah, I love that. We find that when we do have that conversation with our clients, there's two big problems. And tell me if you see this as well. One is when they see their retirement savings, they're not taking into consideration that that's not all theirs, right? Especially when you're talking about qualified money. So when you start talking about Roth conversions and paying taxes and yada yada, it's almost like it's a mental roadblock in a sense, right? Because it's not really a physical roadblock. I mean, it can be, but that $1 million you have, Sue, is not $1 million in your qualified bucket. You're going to pay taxes at that at some point. And I love what you said. If we can establish that this is pretty much your minimum taxes you'll ever pay, granted if they do change stuff down the road, this is where you're going to be at. This is the baseline. You're not going to go below this. You have your Social Security, you have your pension, you have this income coming in. It's not going to get lower than that, other than if they change the tax code, right? So working from there, right, and then just having that roadblock. That's the first one, and then the second one is, for whatever reason it is, when people are looking at their taxable buckets, they always feel like there's something out there from a deduction standpoint that's like this magical deduction that they can write off that we're just, we haven't found it yet, right? To just eliminate all of their taxes. So my question is, Steven, is there a magical deduction that eliminates a lot of their taxes?
There's very little that's magical about the tax code from the taxpayer's side. It might feel like magic from the IRS's side. Yeah, for most people, we're talking about pulling small levers over time. One of the jokes I make to new taxpayers working with me is, hey, I'm not your guy for accounts in the Cayman Islands. I can't make your tax bill disappear. I want to keep you out of jail. And so I make it in jest. We all laugh, but I want to establish right out of the gate that we are going to do things that are acceptable under the tax code. I'm not here to create some strategy where we hope the IRS won't notice for the next 6 years. And so for most of us, most of the clients I work with, and I'm, for the most part, I'm working with people who have done a good job saving. These are your everyday millionaires. Maybe people, my clients will span the range $1 million to 10 million in net worth. So you get above a certain net worth, and you definitely will get into more creative opportunities that are available under the tax code. But for a lot of us, this is about small levers over time. One way to think about this is small hinges swing big doors. The people that I see come out ahead the most when it comes to taxes, the people who aren't getting killed on taxes constantly, the people who can consistently have someone on their team, that might be themselves, that might be a tax professional they work with, but they have someone on their team who's looking at their tax situation and helping them make those small adjustments. And I know that small adjustments aren't nearly as exciting. When you read about Peter Thiel having billions of dollars in a Roth, you getting an extra $6,500 in a backdoor Roth might not sound very exciting. But most of us will pay taxes for 40, 50, 60 years of our lifetime. I know that's a depressing thought, but let's think about it from the positive. That means we have 40, 50, 60 years where we can make small changes, and that's really going to add up. Because now all of a sudden, taking backdoor Roth as an example, it's been a really frequent topic recently. Okay, so right now the contribution limit is $6,500. Okay, great. If I do that for 10 years or 20 years or 30 years, now I have tens of thousands, if not hundreds of thousands with growth in a tax-free bucket the IRS is going to leave alone. Because you mentioned people not understanding that their 401k, that their IRA isn't really all theirs. I see that all the time as well. I tell people that if you have money in a pre-tax retirement account, you basically have a mortgage that the IRS holds, and it's a variable rate. And oh, by the way, they get to pick the rate. And so depending on the state you live in, the other example I'll give people is that, let's use $1 million because it's easy math, especially for my clients in California or New York. If something happened and you had to take all of that out tomorrow, you get about half. And clients will look at me like, wait, no, so much more of that's mine. No, it's not.
Yeah.
You could easily only get half of that. Now, if we take it out slowly over time, it's going to be a smaller number. But that's the other piece I highlight when we talk about Roth. It's not just about trying to guess the perfect combination that we come out ahead on taxes. I love saving on taxes. The other thing is that it creates flexibility because we plan for retirement. And I'd love to hear your thoughts, especially on the annuity side, because from my perspective, one of the reasons people look at annuities is because they want things to be more consistent or more even. They want to take some of the guesswork out of life.
Right.
And so we
Right.
go in planning as if our spending needs will be the same throughout retirement, as though our income will just magically be consistent. That's just not the case. Hopefully we need more income for something fun like an RV or a trip to Europe, but we might need more income for something not fun like a medical bill or a roof.
Yep.
But having that flexibility of a Roth in those moments gives us options. It gives us a choice instead of just saying, geez, I guess I better take 30% more than I need out of my 401k so I can cover the taxes. Say, okay, does it make sense this time that we pull some out of Roth?
Right. Yeah. Yeah. Consistency. We tell people in their retirement to be proactive with their money,
Yeah.
right? Being kind of reactive or passive, it can yield okay results, but it's not going to yield optimal results. Don't chase best changes, chase optimal, right?
Yeah.
So yeah, consistency, that's a great segue here. So there's a couple of things you said there that I'd love to make a segue on, but consistent income. Some people look at income as like a bell curve. Sometimes I like to refer to it as an upside down bell curve. Some people in retirement have their situation, their health, whatever, their income starts to spike. We call it your go-go years, right? Your 60s, maybe even into your 70s, and you have your slow go years. And I didn't come up with this, by the way. I don't remember who it is. Your slow, you remember it was a book I read. Your slow go years, which is your 70s and maybe your early 80s, and then your no go years, which is 80s and beyond, right? But some people they have, maybe they do want that income spike for traveling, spending, whatever. But there's also people that don't like to travel, so maybe their expenses go down, and it's more of an upside down bell curve until maybe they have health issues, and then all of a sudden they need more income down the road, or inflation starts to hit, or whatever. So it's very interesting how everybody's situation is just so different. There's not like this book on, hey, this is exactly what you should do for everybody, right?
Right.
So here's a question for you. So I'm going to go back to your backdoor Roth conversion.
Yeah.
Okay. Or backdoor. Yeah. So we have, correct me if I'm wrong here, right? So I see a lot of TikTokers these days, and I think you and I can both agree that that's probably some of the worst advice you could ever find is on TikTok. But unfortunately, it reaches so many people, right?
Yeah,
It's like,
tons of people.
how do we combat this? And we were doing some TikTok stuff when we stopped. It's like, this is a mess. So essentially, we have these TikTokers and finance or influencers, right, that talk about these tax efficient strategies. One of them being, we all know the kind of LLC, the single member LLC to single member 401k, blah,
Yeah.
blah, blah. And you can max out whatever that is, 60,000 Roth conversion a year. Here's my question on that part. Do you see people actually doing that? Obviously, probably not a lot of retirees, probably a little bit more younger people doing that. Do you see people doing it? And then the second question here is comparing Roth accounts to IULs. That's if you don't mind hitting on that. I don't know how much you know about that side, but what your thoughts are, would love to know.
I will do my best. And I'm always the first to admit when I don't know everything about a topic, and IULs are
Sure.
certainly an area where I don't know everything, but I'll try to touch on both of those. So, okay, let's start on the Roth side. So yeah, I started laughing as soon as you said LLC, because usually, you're setting Roth aside for a second, the number of questions I get from people that are genuine questions of, hey, should I start a business to save on taxes? Should I create an LLC to save on taxes? There's just this real misunderstanding about what an LLC really is, or what an S corp is, or what a partnership is. For most of us, when we talk about business structures, it needs to be a legal decision first, and then we'll figure out the taxes afterwards. In fact, that applies to most things in life. Figure out what the
Yes.
right decision for you in life is, and then let's figure out the tax side. And I'm the tax guy telling you that. So when
Right.
people come to me with tax questions, this is why all the taxpayers I work with have a financial advisor, and quite often I will steer them back to their financial advisor first, unless they're coming to me with their financial advisor. Because on the business entity side, I mean, Tracy, you know this, but I'll say this mostly for, I'm going to assume that most of the audience knows this as well, but think about how you explain this to clients because you're going to get this question. The LLC is a legal distinction. You're going to still pass all of the income through to the individual. And so having an LLC versus just reporting a sole proprietorship on your tax return does not change the deductions that are available to you. But
Yep.
I guess other than you just spent some fees on an attorney that you can deduct now, but I mean, you could have paid the
Yep.
attorney for anything. So yeah, an LLC in and of itself is not some magical tax strategy. You specifically mentioned the solo 401k. Yeah, that can absolutely be a way to get more dollars into qualified retirement accounts. And I definitely see people at times who will do this. But anytime somebody comes to me with a tax saving strategy, especially if it relates to contributions of any kind of getting money into qualified accounts, we have an order of operations we go through. Before we go set up a new entity and a new account and deal with all this administration, it's okay. Are you funding what's already available to you? Because a lot of times this is W-2 employees who want to start something on the side because they're sick of getting killed in taxes, and they're trying to figure out how do I not get killed in taxes, which I can appreciate. But are you max funding your current employer's 401k plan? Are you doing backdoor Roth contributions? Do you have access to an HSA, and are you funding that? There's other things that we can go through first. Another one that gets missed quite often is for married couples where only one spouse works. The IRS does not distinguish between the two of you for earned income. So I've got kids. My wife does a fantastic job taking care of them. She doesn't have earned income outside the home, but she still gets to contribute to retirement accounts in her name because together we have earned income. And so that's one that gets missed is people, I want to go set up a solo 401k. Well, are you even max funding the things available to yourself and your spouse? So
Right.
that is where I start. And if we filled up all of those things and they say, yeah, let's go, let's do more. Okay, great. Let's look at setting up a solo 401k. Like we can absolutely go down that route. There's some things we really need to keep in mind. It's not just like, let's check a box and move on, especially for W-2 employees. There's some pretty strict rules around what that, if you already have access to one 401k plan, there's a lot of rules around what has to be different to be able to set up another one. So if I'm an accountant and my W-2 job is as an accountant, and then I go set up my LLC and then try to run things through as an accountant doing the same thing I do in my day job, there's limitations on that. Basically, the IRS doesn't want you to be able to just start popping up solo 401ks in 17 different LLCs. They're wise to that.
Yeah, that's good. Yeah, I see a lot of people in my industry that I don't know where they got the information from, but it's like, oh man, I need to really do this. I need to set up this, these separate entities, and so I can do these solo 401ks and do these, one time a year Roth conversions, yada yada yada. And it's like, okay, let's take a step back, you guys. What are you doing right now in your current situation? Or what is it? I have this is always a funny one. You go out and you have a business expense, and you can, you write off the business expense, and you can have vehicles, blah blah blah. What people don't understand is that when you write off a business expense, you're not getting that for free. You're just saving on the taxes on it. You're still paying for it. So it's like people will go try to, I call it robbing Peter to pay Paul, right? Yeah. Oh man, I have this $10,000 tax liability. I'm going to go buy a $50,000 truck or a $70,000 truck. It's like, what are you doing?
So that goes back to make good life decisions and then figure out the tax side. If you're doing something purely for taxes, if taxes are the only reason you're doing it, just take a step back and make sure that really is a good decision. Because most of the time we want to make otherwise good decisions and then figure out the most tax efficient way to do it.
Absolutely.
So,
yeah.
So Tracy, I wasn't trying to dodge the question about IULs. We can come back to that.
No, that's okay. We can tag team it too, because I think I know enough about them.
Well, so again, I'll just go ahead and throw out there that there's not something I'm an expert in. I've never produced life insurance myself. I know some life insurance people that I have a ton of respect for, and I think there is absolutely room for life insurance products in people's lives. All of that said, one of my biggest frustrations with the IUL crowd, especially from a tax savings standpoint, is just philosophically, if you can't lead with what your product is, maybe you have an issue. And so the 100%. number of DMs I get on LinkedIn where I know immediately, I get enough of these things, I'm around it enough, I know immediately when this is going to end with an IUL. but they're always coming up with these new pitches for
Yeah.
tax-free income streams and the supercharged Roth. This is even better than Roth. They refer to all of
Right.
these things, and every now and then when I'm feeling like having a little bit of fun, I'll go down the rabbit hole with them just a little bit to see how many messages in before I can get them to admit that they're trying to sell me life insurance. And I've had people, I just within the last few, I lose track of when my podcast airs just because there's such a lag between recording and airing. So, but sometime in the last few months, this summer at the latest, I had somebody come on and talk about how they use life insurance products in their practice. I'm not universally opposed to it. But again,
Right.
if you have to lead with everything other than the name of your product,
Yeah.
you probably need to think differently about this. There's a place for it. I don't always know how to articulate that because I've been rubbed the wrong way so many times on this topic.
Right.
But yeah, I mean, they're definitely I mean, they haven't been outlawed yet for a reason, I think.
Yeah. Well, perspective here is everything. And it's almost like you could, if you put yourself in the perspective of somebody else's shoes, whatever, you can kind of understand why people have such a bad taste in the mouth over not, I mean, we can talk about the insurance side. I can talk all day about how annuities are bad. It's, if you can't, then you probably have a problem, right? If everything is a nail and all you have is a hammer, right? That's an issue. And that's where, I say that because I only do annuities, but I can recognize that, right? So it's a little bit different than what a lot of people do.
Well, and I'll say that the same thing is true about Roth conversions. That's why I was very intentional about saying they should be considered and not that they should be
Right.
done, because people will do the same thing with Roth conversions. Everyone has to convert all of their money to Roth. Well, maybe, but yeah, to your point, if all you have is a hammer, everything feels like a nail. And I like what you said there. I want to make sure that everyone really heard this. Is whatever you're doing, whether you're a tax guy, you're an annuity guy, you're an insurance guy, you should be able to clearly articulate when your strategy or product is a bad idea. And if you can't
Right.
clearly articulate when it's a bad idea, it's time to reevaluate because nothing is a universal fix.
100%. Yep. We tell all of our advisors that if people come to me, I'll have agents, and the problem with what we do is that it's kind of a low barrier of entry, right? You go get an insurance license, you study for 2 weeks on the insurance license, you can go sell fixed annuities, index annuities, you can sell SPIAs, DIAs, whatever. It's like, man, now to do it appropriately, it's a pretty high barrier of entry. But essentially, we'll get emails all the time. Hey, here's a situation. How does an annuity fit? Or here's a situation. I want to try to sell this. I'm like, if you're trying to sell and you're not solving, you're creating a problem. The first thing I'll normally say to them is, what problem are you trying to solve?
Yeah.
And if they can't reasonably articulate that, then you're creating one, right? That's how insurance works in general. So I'm going to go back to the IUL conversation because I think it's good because we have a lot of people that follow us that do the IUL side and annuity side and whatnot. So essentially, this is how I see the IUL side. First and foremost, in any insurance side, is it's life insurance. First and foremost, it's life insurance, right? So if you're not solving a life insurance need immediately, right then and there, then you're done. Okay. So if you're going into it as this tax saving, retirement vehicle, whatever, and there's not a life insurance need, you need to pretty much get rid of that idea, right? So if you're solving a life insurance need first, because there are dollars that go into that for life insurance, then now you're on the right track. If you can do that, now you go into what are some of the advantages. Here's the problem I have with it. And here's why I think when you start to compare Roth accounts to IULs, it's there's too many variables that can blow up in your face, essentially, right? So we see as a Roth account as, very simply put, you're putting in after-tax dollars. It's growing tax-free. Essentially, you now have control of that money, which is very advantageous in retirement. We talk about how having control of your assets, having the government not have to tell you when to take money out, RMDs, it allows for not only your own spending habits and be able to control those spending habits, but also it reduces things like sequence of returns risk, and as well as we don't know what the tax code is going to do in the future, right? So what if taxes go up? What if your income goes up? What if you're in a giant tax bracket with that money? It's just easier for planning perspective for some people, like you said, not everybody, right? The IUL side, that's there's a decent amount of variables there, but on the IUL side, here's all the variables. If you improperly fund it, you just destroyed it, right? So you put too much in, you take too much out in a certain time period. You use the wrong product that didn't grow appropriately, which now you've opened up Pandora's box on that. You have an unbelievable amount of fees inside of them for your first 6 to 10 years. And then even after that, to really properly fund it, you really need 30 plus years, in my opinion. Okay.
Mhm.
So if you don't have that kind of a time perspective and you can't commit to something like that, and even if you did, there's so many variables behind how it grows. And if it doesn't grow appropriately to offset a lot of the fees and penalties and whatnot inside of it, it's going to blow up in your face. And the problem with it is that you can't control the variables inside of it. The insurance company does, and that's a big issue, right? Versus at least I know in my Roth account, at least I know if I go buy an S&P 500 ETF, I know what it's going to do, right? I know what it's going to do. It's going to follow the curve of the S&P. If I go buy an S&P fund or index fund inside of a Roth account, they can change how that index is credited anytime they want. And that's a problem, right? So what I see as the biggest problem here is the fact that you're comparing apples to oranges. They shouldn't ever be compared to each other. If you're going to use one vehicle, it should be supplementing the other one. And this is what I'll also tell people about annuities as well, is it's supplemental. It's not a replacement a lot of times. It's supplemental. People look at annuities as bond replacements. That one I could probably argue, but it doesn't mean that bonds are bad at all. It doesn't mean that you should be replacing them at all times. Bonds can be phenomenal compared to annuities in certain environments. Maybe not an environment today, but in certain environments they can be. So anyways, okay. Unless you have any questions or unless you have any comments on that, I got another question for you.
No, let's keep marching on.
Awesome. Okay, so we're going to be wrapping up here soon. Estate and gift tax, just in general, right? We have clients that ask us about it all the time. How do retirees plan for these types of considerations? What are your general thoughts, or at least general advice, in the whole estate and gift tax conversation for retirees?
That's a good question. Actually, I had made a note to myself of one thing I want to reinforce around Roth that this kind of ties back into really nicely. When we talk about that, when I talk about it, everyone should consider it, but it might not be the right fit for everyone. And back to this, hey, let's make good life decisions. One of the things we have to know before we start converting to Roth, especially aggressively, is what do we plan to do with our legacy? What happens to our money when we pass away? Because I'll run into this where you have people who get really excited about the idea of Roth, and we say, okay, let's, I know this isn't everyone's favorite topic, but what's going to happen to what's left over when you pass away? Oh, there's this charity that I love that getting everything. Great, full stop. We're not going to we're good. There might be situations where we still help them convert a little bit to Roth, so they have flexibility and retire because we know RMDs are coming anyways. But it's okay. What's going to happen at the end? So when we talk about estate planning, we've got to look at what are those goals? What are the level of assets involved? 2026 might also have an impact on what we do around estate plan, or especially estate taxes, because right now the exemptions are just absurd. Really in a good way for all of us, because it's right about 13 million per person, which means for a married couple it's 26 million. And so we've got some states out there that have a lower threshold. It goes all the way down to, I think, Oregon and Massachusetts are down around 1 million. So depending on the state you're in, that might be a little bit different. But honestly, for most of the people I work with, estate taxes are never going to come into the picture. Now, but the thing I try to point out with that is that does not mean that estate planning doesn't come into the picture. Because again, you got to make good life decisions and then figure out the most tax efficient way to do it. Everyone should be doing estate planning of some kind. There's some basic documents that all of us should have in place. And I'm not an attorney, so I'm not going to try to get into the details of that. But if you've never had a conversation around estate planning, that is worth having, regardless if you're going to pay estate taxes someday or not. Because estate tax, you mentioned estate taxes and gift taxes, because they get lumped together, because if in a given year you go over the gift reporting limit, then it's going to count towards your lifetime exemption. That's another piece that people get wrong when we talk about the $17,000 that you can gift every year. My years always overlap depending on whether I'm preparing this year's returns or planning for next year's. But I think it's right about $17,000 right now that you can gift to anyone you want to, and the IRS doesn't care. It's not a tax deduction for you. It's not taxable to the person you give it to. But if you go over that $17,000, now you have to report it to the IRS, and it's going to start counting towards your lifetime exemption. So this is another area where, yes, we want to make sure we have a plan for the taxes, but you need to start with the other things. You need to start with, what are my legacy intentions? Have I taken care of the other estate planning considerations before we ever look at the taxes?
Yeah, that's great. I love how you you linked legacy with Roth, and it's something that is a big part of our conversation, because when somebody does have Roth money or they do Roth conversions, we really try to use it in two buckets. One is you use that money when you need to make a purchase, but you could be spilling over into a larger tax bucket that year, and you try to want to avoid that at all costs, right? Save taxes on that. And then the second one is, I would say, like, we call it the death tax, right? If you pass away, you and your spouse obviously are taking higher income. If it's qualified, that person now, that all goes on a single, as a single preparer, right? So now all of a sudden, you thought you were going to be in this 22% tax bracket, and all of a sudden now you're in this whatever 30 plus. So Roths help with that later down the road when you're taking that income in. And then obviously, if you do pass away, passing Roth accounts to Roth money to others doesn't give them this giant tax liability, right? But again, doesn't mean it's right for everybody. And again, reiterating that, like, time and time again, I think is very important. These are all great benefits, but there are still drawbacks to them, right? Okay, last thing for you. Could you, I'm going to put you on the spot here, okay? Could you share a scenario that you've had, either recently or at some point, where you helped somebody specifically with your services, just one that really stood out, just briefly, how you helped a situation from a tax perspective in retirement, that somebody could kind of take home and just maybe not apply it to theirs, but just have it as a thought, and especially advisors that are listening as well.
Yeah, there's a couple of things that immediately come to mind. Thankfully, we get a lot of opportunities to work with people and to help people. Taxes are such an emotional and painful topic that sometimes it's even little things. Just this last week, I was on a call with a taxpayer who, this is rewinding the clock a couple of years ago, when the insurance mandate under the Affordable Care Act was getting contested in the Supreme Court. There were a lot of tax professionals who were helping their clients basically file refund requests, because if that wouldn't have been upheld, then people would have been eligible for refunds for the additional Medicare tax, for the net investment income tax. And so it's a new client to me, but their former CPA had helped them file one of these letters. They got a response from the IRS, and they basically were like, "Well, what's going on now? What's the status here?" And it got kind of convoluted with how it went through the Supreme Court. Ultimately, they're not eligible for that refund, but even just we're only on the phone for a couple minutes. They asked about my medals, and then we talked about this court case. But they were just so appreciative that I would close the loop for them, that I would just articulate for them what had happened and what was going on. So that's a really small example, but even the simple things are very valuable to the client. Other things that we're doing quite often, we're helping people understand the impact of Roth conversions at various levels and making sure they actually execute on that. We help people get backdoor Roth contributions done all the time. That gets done wrong so often that we've actually created a masterclass that's going to release right after Thanksgiving, all about how to get backdoor Roth contributions done. So that's one that comes up a lot. You asked earlier, or you maybe suggested that clients might ask, "Hey, is there a magical deduction?" There still isn't. I wasn't saving it for the end, but we get that question a lot as well. And so, especially with pre-retirees, retirees, people who have been saving and are ready to start having an impact with their wealth, we do a lot around strategic charitable giving, whether that's as simple as bunching contributions every other year, every third year, or it's doing things like donor advised funds or getting people set up for qualified charitable distributions. These are all things that start to have an impact, little things that build over time. And then the other thing that I encourage every advisor to do is to make sure you're getting tax returns for all of your clients every single year. Because if anything that you're doing has a tax impact, and spoiler alert, it does. Everything you do as a financial advisor or a financial professional of any kind, there's money involved, there's a tax impact. It's going to come through somehow on their tax return, whether it's intentionally getting more into their tax return, intentionally leaving things out of their tax return. And so this is a fantastic way to help make sure that your planning got reported correctly, because until it gets reported to the IRS, it didn't happen. It also reinforces to the client the value you're providing. If you're getting their tax return and saying, hey, Bob and Sue, right here on line 4, this is where we're seeing that activity from that backdoor Roth contribution. And here's where we got another $13,000 into your backdoor Roth this year. And so being able to highlight that for them, we like to call it the dishwasher rule, which is making sure you take credit for the things that you do. This comes from the idea that you only get credit for doing the dishes if your significant other knows. And so when I said, hey, make sure you consider a Roth conversion for all of your clients, make sure you tell them, even the ones who you're not going to do a Roth conversion for, make sure you let them know, because they're hearing about Roth from conversations like this, from podcasts like mine, from TikTok, from the internet. They've heard of a Roth. They want to know that someone's looked at it for them. So that's the dishwasher rule. Make sure you're reinforcing and telling your clients, here's all the great things I did for you.
I love that. I love it. Okay, so let's close this out with, I'm a consumer, I'm a financial professional, I'm whatever. I want to know more about what Steven does. How can I get a hold of you? How can I work with you? What do you have going on? You know, I think you wrote a book, right? Is that what you said? You wrote a book. How do I get a hold of that? Tell us all that.
Yeah, so if you're a consumer, I wrote a book called Don't Get Killed on Taxes. And this is really focused around helping people understand building blocks around taxes, because we're all expected to pay taxes, and no one ever taught us what that meant. So first part of the book is, here's kind of the foundation of what taxes mean for you. And then the second half of the book is different strategies that may or may not be applicable for doing those consistent things over time. So that's the biggest thing from a consumer standpoint. And then I also co-host a podcast for consumers. It's called the Retirement Tax Podcast. We're working on rebranding it to the Least Boring Tax Podcast, really leaning into that. I do a lot more for advisors. The Retirement Tax Services Podcast, if you just search my name on Apple Podcasts or Spotify, you'll find it. I'm very, very active on LinkedIn. I put out a lot of content there. Our website is retirementtaxservices.com. You can go and download our tax reference guide for free. I will ask for your email address. I will send you a weekly email that has relevant tax stuff. I am completely focused on how do people take action. So I'm not going to quote the IRCs at you. I'm not going to sell you products. It's just going to give you snippets of things that you can apply in client meetings, things that you can apply in your own content. But those are the best ways to follow along with what I'm doing.
Awesome. I love it. Well, Steven, much appreciate your time. Obviously, anybody who's listening to this can tell Steven knows his stuff. So thank you for being here. Much appreciated. And you know, hey, for the rest of everybody who's watching this, I think Steven said that he has a course, right? You have a course?
We have a course coming out right after Thanksgiving on how to get backdoor Roth contributions done. So go get signed up for our email list or follow me on LinkedIn so that you can see the announcements when those come out. But it's going to be good.
Perfect. I'll definitely be looking at that. So Steven, hey man, thanks for your time. We appreciate it.